Good morning, friends. Today is 21st of June 2020. I hope you are enjoying your Sunday and happy Father's Day to all fathers. Now, today in the morning, the topic I want to discuss is the increasing volatility of markets. I believe all of you would have seen, we are going up 1200 points in 2 weeks. We are crashing down 800 points on the Nifty in, you know, basically 6 odd days. And, just the intraday volatility. Bank Nifty at least twice every week, has that 6 to 800 point move on either side. I mean, I am from a time in 2000s, and even the best moves used to be like 50 to 80 points. It's obvious something is changing in the market, and what is changing is the huge intraday volatility, and because of that, even the day to day volatility is extremely high. It looks like nobody is doing portfolios anymore, and everybody is into intraday trading. Now let's see what I am talking about. This is the 15-minute chart of the Nifty. Okay, this was your 95-50 day. Same day we reached almost 10,000. This was 350 point move. Then on the next day, from 9900, we fell to 9700. Okay. Then on the same day, I think we turned around and we went up, 300 points to close at 9850. Again, the next day we opened gap up, and then that India-China news happened. We crashed down to 9700. Then the very next day we reached 9950. Then again we, fell to about 9820. After that, we had those two large rallies of 200 and 150 points. How the hell do you deal with all this? Okay. Why? Because for people who have this figured out are people who are able to benefit hugely. And this can be quite unnerving if you have a position in one direction and the market moves against you by 200, 250 points, even on an intraday basis. So what has assumed great amounts of importance today is trying to find out the exhaustion points in the market. If you are not operating at an exhaustion point, then chances are your stops will get hit. And that is why trying to be a futures trader is so difficult. Okay. The problem in futures trading is that with this kind of volatility, the market noise can take you out. So, how do we deal with this sort of a situation? Basically, for an intraday trader, what is important is to see where the pivot zones are. Where is the previous day low, or where is the previous day high? Because what is happening is that the market on one day goes to a previous day low. The second day it turns from a previous day high. So this sort of volatility, it becomes quite impossible to trade without these key levels. So as you can see here, let's go to the 5-minute chart from here, and 17th of June, the lows of 2 days match 17th and 18th. So here was your trade which was set up. If we go back a little bit, as you can see here, the high of this day went into high of 17th of June, crashed into this congestion, and from there you started to come off. But it wasn't a perfect setup, but it was one that could have been taken. Now, 15th of June, we had the low at about 9690. 17th of June, the India China LAC day, again the low got retested. So the reversals are happening from the lows or the highs. Now, 14th of June, the high was about 99.80. On 16th of June, we went above 99.80 and slowly we started to fail from that level. So again, you had some sort of benchmark to measure this kind of failure. So when you are coming into the market, what you need to have a very clear idea of is where is prior day's high and low. Okay. Again, if we go back to the 8th of June, 8th of June, we made that high of 10,334. 9th of June, we went back to it and then crashed from there. Okay. Early morning, we tested the lows of 8th of June on the 9th of June and rocketed up. This is a very, very large move. This is almost 150 points. So as you can see, you know, things are ordinarily difficult. Okay. And it requires, huge amount of alertness, mental swiftness. Now, this blue line is the 200-day moving average, which broadly is the pivot for the day. As you can see here, we went up, we crashed back into this 200, and from here, you had a large rally. Okay. Other than these points, I would call the rest of the points random because they are out of syllabus as far as I am concerned. Okay. Again, on 29th of May, the market is giving you this dip. Now, this has to be done with a great amount of anticipation that since you are in an uptrend, the market will buy into all dips. Okay. So, not exactly high and low, but getting into a congestion zone is also as good as a support or a resistance. You see here, 27th of May. Now the low of 26th of May was 89.70. The low of 27th of May is almost the same, which is 89.70 from where that large rally began. So the idea is that we have these points on the charts. You can also match them up with Camarilla pivots, etc. And often these turn out to be reversal levels. Okay. If you see, this was that RBI package day, 22nd of May. You rallied into this congestion of 21st of May and then you crashed back. Okay. Now here, you can see that we went up, crashed back into the 200. This is the blue line is the 200 of the 5-minute chart. And from here you began a large rally. So these are some predefined points where you can act. Okay, here again you can see this 200 stop the market action. Okay. So this is the kind of method. Again, this is a resistance zone even marked with a pivot. So you can have your own methodology to find support resistance, or you can use these mechanical tools which help you, find support resistance. Plus you have this congestion. If you see on this day, 26th of May, this high and the high on 24th of May are almost the same. So that is how you can deal with this level of volatility. If you say, for example, get in somewhere here in between, you are in a serious load of trouble. Okay. So very important that you know what you are doing and where your key levels are. Now, okay, you have found out your support and resistance, market goes there. Now, how do you play it? The weekly options are now being used as a substitute of futures. Why? A, futures have become extraordinarily volatile. So the problem you have is, even if you put a 200-point stop, it's not enough on the Nifty. On a bank Nifty, maybe 500 is not enough. So you need a method where you can get asymmetric returns. Now, what is an asymmetric return? That you, if you have to lose, you lose 1 rupee, and when you make 2 times, 3 times, 4 times. So that becomes a very key instrument of trying to deal with volatility, because otherwise, you know, this amount of volatility is just extraordinary, and is very difficult for most players to deal with. So similarly, let me show you in the last few days what happened to the Nifty June options, so that you can make out what is going on in terms of dealing with volatility. On the Nifty option, say you want to go long. There comes a time when these options become extremely cheap. This is the 10,200 call. So it becomes extremely range bound once it's more or less, it only has the time value involved. So this is the kind of zone where you have to buy cheap options. Now on the future, this period would basically be around these levels at 98.50 when the future is trading. The 10,200 call is about 50 points, about 60 odd points. And if you get in when these options are very, very cheap and nobody wants them, that is when you create a 1:2 or 1:3 risk reward. This 50 rupee option in 2 days became 170, the June 10,200 option. So to manage risk both on a swing basis as well as on intraday basis, let's examine what is happening on the daily chart. I pointed out earlier in a swing video that you have to buy when there is exhaustion on either side, and hence you buy an out of money call or an out of money put and believe that the market is now exhausted on one side. You know, when a market moves in this manner from 9,000 to 10,300, it exhausts. Similarly, when it moves from 9,900 back to 8800, it exhausts. So these days, because of futures and options, there is exhaustion on both sides. And unless you are able to figure out the exhaustion, life becomes very, very difficult. Okay. So the advice is that, to manage this level of volatility, you have to use an instrument which does not go against you by a large margin. Because if it does, managing risk is a huge problem. In this, you can use your gap up, gap down strategies. If you are gapping into a previous day low, similarly, previous week low, previous week high, previous month low, previous month high are also very relevant levels. Okay, so this is the previous week candle on the Nifty. So again, these are very, very important levels, the high and low of the previous week. Even strong reversals can come in from these levels. See, the entire market is now a trap. Okay, so a trap means that the average guy thinks that the market is going down, but it suddenly reverses and starts to move up. Or if the average guy thinks that a market is going up, uh, going down, the market suddenly reverses and starts to go up. So this is the dilemma, which has basically changed not only Indian markets, it has changed global markets. So globally, the volatility has increased to levels which have not been experienced for many years, and that is the reason those large views 7500 and 6000 etc are not very easy to play out, and you don't need them because the issue is the markets are basically moving all over the place, and in a year's time, on a intraday basis, monthly basis, weekly basis, the sort of large moves you can get, I think, needs a new level of skill where you should be able to make out turning points which are based on exhaustion. Okay. I have given you my 3 points, which are the 200 period average or the pivot, plus for people who like floor pivots, it could be S1, R1. For me, I have my Camarilla pivots, but the issue is that risk management has assumed a new degree of importance, and if you don't do that, that is where the real problem starts. See, the instrument you can choose, but what you can't choose is this incredible amount of volatility where markets can move against you by a very large margin. So this is a sequel to yesterday's video on options, because I felt that this amount of volatility should have a proper method. See, the markets can reverse from anywhere, but if they reverse from a framework that you are practicing, then life can become a bit easier. Okay. So for Monday, for example, what I am looking for right now, they say that we are about to gap down, and this is the nearest congestion. Below this, the congestion is at 10,130 to 170 thereabouts. The next congestion is at about 10,050 thereabouts. So let me see what my pivots are saying. Pivots are telling me, the daily pivot, that 10,176 seems possible. What is my S1 saying? It is saying 10,100. So somewhere in the 10,100, 130 style zone, I would like to look at a reversal. Okay. Now let's see the Bank Nifty. The rally in the last couple of days is so large that once the market starts to give up ground, so first level here is 20,980 thereabouts. If we go through this, the second level is 20,680, which is the 200. On my pivot, what I am interested in is again looking at S1, which is at 20,932. Okay, so for the moment, these are the levels we go with, and then we'll have to see the situation on Monday. This is the, again, my plan, but whether it's successful or not, we'll have to see on Monday. If you are unsure, don't do anything. That should be it for this video. Take care, trade well, and please consult your financial advisor.